You finally scraped together $2,000 to start investing, opened a brokerage app, threw $500 into that electric airline pizza stock your cousin wouldn't shut up about, and boom, it drops 38% in 3 weeks. So you yank the remaining cash out, stuff it back into savings, and tell yourself the market's just a casino. Sound familiar? That stomach drop moment is exactly why 90% of first-year investors never make it to year 2, with the scars and lighter account balances to prove it. My name is Tito, and I spend way too much time thinking about why smart people keep making the same rookie investing mistakes. If you're someone who finally saved a little cash, opened a brokerage account, and still feels clueless about what actually belongs inside it, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Here's the thing, the mistake isn't picking the wrong stock. It's not timing the dip perfectly, and it's definitely not failing to watch 47 TikToks before you hit buy. The mistake is skipping the part that feels boring, deciding why you're investing in the first place. 92% of new investors, according to a 2023 J.D. Power survey, open an account without any written plan. Just vibes. And vibes are terrible portfolio managers. Look, when you don't predefine the goal, every red day feels like the apocalypse. The market's job is to fluctuate. Your job is to know whether a 10% drop is a 5-alarm fire or Tuesday. Without that context, you become the person who sells low, buys high, and then blames Wall Street crooks for the bruises. The data backs this up. Dalbar's annual QAIB report shows the average equity fund investor underperformed the S&P 500 by 3.6% per year over the last 3 decades. On a $10,000 portfolio, that underperformance gap costs you about $30,000 over 20 years. That's a new car gone because you treated investing like fantasy football. So how do we fix it? First, write the plan before you fund the account. Not after. Not when you have more money, before. The plan only needs 3 lines. 1. Goal, I want $45,000 for grad school in 7 years. 2. Risk, I can handle a 25% drawdown without panic selling. 3. Contribution, $450 auto-deposited every month. Boom. That's it. Now every investment you buy has to answer to that page, not to Jim Cramer or your group chat. Here's what most people don't realize: the plan actually lowers your tax bill too. When you know the time horizon, you can pick the right account. 7-year goal. A regular brokerage keeps things flexible. You'll pay long-term capital gains 0-20% instead of ordinary income rates if you hold over a year. Retirement at 59.5. Drop the cash into a Roth IRA. 5 decades of tax-free growth on the back end will crush a string of short-term trades, even if you win a few. This is where it gets really interesting. Your behavior beats your brain. A Fidelity study looked at 5.2 million retail accounts from 2003 to 2021 and found the best-performing cohort was dead people. Seriously. Inactive accounts outperformed active ones by 1.4% annually. Turns out rigor mortis is the ultimate risk management tool. Takeaway: the less you mess around, the more compounding works. Automate the deposit, automate the index fund purchase, then go outside and touch grass. Now you might be thinking, Tito, I still want to pick stocks. Let me live. Cool. Budget your fund 5% rule. Keep 95% of the portfolio in broad, low-cost index funds that match your plan. Take the remaining 5% and YOLO to your heart's content. If you strike gold, great. If you blow up, the other 95% keeps your goal on track. Think of it like spicy sauce on a burrito. A dash adds flavor, but nobody wants a bowl of pure habanero. Let's run quick numbers. Say you invest $500 a month for 30 years. Option A, chase memes, trade 22 times a year and earn the average DIY return of 6.4%. You end up with around $474,000. Option B, buy a total market index, do nothing, capture the market's historic 9.9%. Final score, $961,000. The difference is almost $500,000 and about 20 fewer panic attacks. Psychology side note: Losses feel twice as intense as gains feel good. That's prospect theory, Nobel Prize-winning stuff. So when your speculative EV stock tumbles 30%, your brain screams, sell now or die. A written plan acts like a prenup against your future emotional self. You literally wrote a contract with tomorrow that said, we expected turbulence. Stay buckled, objection handling time. But Tito, the market feels high right now. What if I buy the top? Look, nobody rings a bell. Vanguard calculates that perfect timing beats dollar cost, averaging only 33% of the time over 12-month periods. The other 67% of the time, getting in beats waiting out. Translation: time in the market, timing the market. Start with a chunk, add rhythmically, and quit pretending you're Nostradamus. Another one I hear: I only have $100, indexing is pointless. Fractional shares say hi. Schwab, Fidelity, Robinhood, every major broker will slice you a piece of VTI for as little as $1. The math is identical, only the comma placement changes. A $100 investment compounding at 10% becomes $1,083 in 25 years. Do that monthly and you're a millionaire on $165K of contributions. The barrier isn't capital, it's procrastination. So here's your action step, and it's non-negotiable. Before you buy one more share, open a note app and write the 3-line plan: goal, risk, contribution. Screenshot it, set a quarterly calendar reminder to reread it, and then fund the account. If the investment you're eyeing doesn't fit the plan, you don't fit the investment. You made the hardest move already, you started. Don't let the absence of a simple plan torpedo the next 20 years of compounding. Subscribe for more no BS money breakdowns. Drop a comment with your plan once it's written, and remember, wealth is built on boring, repeatable decisions, not on one killer stock tip. Now get out there and let your money work while you get back to living.